My lens on that is a statement that I quite often make, and that is ego is expensive. And ego has two sides to it. So it's either expensive because you got to dial it up too far, or it's expensive because you haven't got to dial it up enough. And in Australia, quite often it's expensive because they haven't got to dial it up enough.
Hi everyone, welcome to episode 137 of the Startup Playbook Podcast. I'm your host Rohit Bhargava, and each week I interview successful founders, investors and subject matter experts on how they got started, the strategies they use to succeed and their advice to current and future entrepreneurs. I'm delighted to be kicking off 2021 by bringing back one of our most popular podcast guests to date, Matt Allen. Matt is one of Australia's most successful and active angel investors, having been the first check into many successful Australian startups such as Buildkite and Practice Ignition, who were previous guests on this show. Matt is now the CEO of Traktor Ventures, a revenue-based investment fund that provides an alternative source and option for founders looking to access capital to unlock growth or to develop their own safety net through secondary offerings. We covered a wide range of topics in this interview, including Matt's approach to building a portfolio, when founders should consider hitting save by offering secondaries, why selling equity can be extremely costly for founders in the long term, how to balance having too much or too little ego, and why founders need confidence capital, and much more. Without further ado, here is my interview with Matt Allen. Hi Matt, welcome back to the Startup Playbook Podcast, and thanks so much for taking the time to come back on the show today.
Thanks for having me again.
Matt, for those people that may not have listened to our first interview 4 years ago, or for the few people that aren't already familiar with you in the startup ecosystem in Australia, do you want to share a little bit about your background and what got you here today?
Sure. So now I'm a full-time investor and CEO of Traktor Ventures. Prior to that, I was on the startup team at Amazon. We were looking after venture capitals and startups. Prior to that, I was a technical recruiter and built out some of the software engineering teams in Melbourne, including Envato and Redbubble and realestate.com.au. Prior to that, I was a founder, a technical founder, software developer, self-taught. So 15 years of starting things, and there were sort of three significant ones, two that we sold and one that we shut down.
One of the most fun things about doing this podcast for 4.5 years, and especially having interviewed you about 4 years ago now, is that I get to look back and listen to our previous recording and to see what's stayed the same and what's different. One of the things that you didn't mention in terms of your background was very early on you built a website for Grinspoon.
Yes.
Again, for the benefit of people that may not have heard that story, do you want to share a little bit about how that came about?
Yeah, it was a combination of me being a web developer and me being into local Australian music, and I think there might have been an IRC channel full of Grinspoon fans, and at one point in time I just contacted their manager and said, I want to do your website. And they said, what's a website? We then built the website, and for quite a long time there, like grinspoon.com.au was owned by me. It wasn't owned by the label or the manager or the band member. It was me. So it was fun. It was a completely voluntary position, but they did pay me with my first digital camera, a Kodak piece that had, I think, like an 8 meg card in it there, and go take some photos and then go home and upload them, and they'd be on the website the next day. And that was pretty new back then, before there was any iPhones or cameras that allowed you to do that.
Listening back to that story now, from that time ago, and obviously seeing your journey, not just over the last 4 years, but I think you've been angel investing for probably about 8 years or so?
Yeah, 2004, 5? Yeah. Quite a while.
Yeah, I mean, in Australian terms anyways, like I think you were a little bit early on both sides, but early in the sense, like I think you kind of helped lay the groundwork for, what's kind of almost now a thriving angel investment scene in Australia. But one of the similarities that I sort of heard from you sharing that story in our initial interview was just going there and trying to find ways to add value to people, which is obviously something very similar from an angel investment perspective, but also one of the things that I think you're most known for as well. Do you want to share a little bit about, I guess, where that sort of comes from and how you approach that from a startup perspective?
Yeah, I think everybody has value to add. Everyone knows something about something specific that, other people would like to learn a little bit more about or take advantage of for, in the nicest possible way. And I just genuinely believe that if I help out enough people, and it doesn't have to be, hands-on keyboards, writing checks, spending a bunch of time help. It's purely listening to people and giving them, kind, honest feedback. And then if they get to the point where you think they are doing something interesting, just like put some active cycles into thinking who else might be able to help them, or who else might they be able to help. So I don't think there's many people that get up in the morning and go, today I'm going to, I've got a bunch of meetings, and out of that, the main artifact that I've created for such a long time is connections. And I try and keep the bar quite high. So sometimes some people will talk to me and it doesn't go any further than that. And it's hard to say exactly when it's going to go one way or the other. But I think that by keeping the bar high, and if it's someone that I'd be happy to work with, even if I can't work with them, I will pass it on, and I'll be very honest with the person I'm talking to, who I always double opt in, so I'm never dropping someone into someone's inbox or message system without permission. I think that's a really critical point, is that no one's getting surprised and having their expectations governed by me going, hey, by the way, Rohit, you should talk to this person, and then just walk away from it. So I think the etiquette there has been really important, and I don't like it when people do it to me, therefore I don't do it to other people. So I think that probably has driven a lot of why people might suggest that I'm a helpful person, because I try and genuinely be helpful.
How do you just mentioned that you have a bit of a filtering process, and maybe there isn't a set criteria that you follow. Like, I know for me, one of the challenging parts of this podcast over the last 4.5 years is, at the start I was trying to ping everyone and trying to get anyone to say yes to coming on the show. Now there's a lot of inbound requests, and try and balance that. I imagine very similar sort of story for you, especially with Traktor Ventures, which we'll dive into as well. How do you balance that for yourself? And I guess, how do you sort of maintain that filter so that you're, in something that's such a relationship-driven industry like we're in, that you're keeping those relationships strong, or at least, maintaining that without burning yourself out?
Yeah, and like, I have burnt out. Like, when I was at Amazon, like, I hit a wall pretty hard. It was the amount of inbound versus the amount of time I physically had to talk to people was out of whack by a ratio that'll make your eyes water. And now I try and allocate some time. So I use Calendly a lot. So, I allocate chunks in my calendar and be quite diligent around it's Tuesday to Thursday. There's a couple of hours, they're 20-minute conversations. There's a gap in between, so I can follow up and not have to do it all at the end of the day. That's my main mechanism. And it ebbs and flows. Sometimes they're empty and sometimes they're full. And most people are grateful to be able to get in, even if it's in 3 weeks' time. And I try not to spend too much of my time. And look, I'm happy to speak to most people for that first conversation. And in COVID, in Zoom times, it's far more efficient. The volume went up, not down. I am happy to, 20 minutes is fine. I do have to curb it sometimes, especially when I've got a lot of other work that I'm meant to be doing. Until Traktor launched at the end of 2020, I didn't have a lot of other work, so I was happy to have conversations. Yeah,
I think it's really curious to understand how you balance this, because obviously you sit across so many different things. You've got your portfolio of angel investments, now you've got Traktor, you're part of a number of syndicates, and just generally involved in pretty much everything as well. How do you sort of balance your own time, or I guess, when you do feel yourself getting to that burnout stage, is there anything that you follow that has helped you, particularly given sort of everything that happened last year? And as you said, for the most part, for a lot of people, things got dialed up rather than getting dialed down.
I spent a surprisingly large amount of time on the couch. I work from our living room, or our upstairs living room, and I have a standing desk, so when I'm not standing, I'm sitting on the couch. I don't actually work all the time, so I mentioned the artifacts I produce nowadays are generally connections to people via messaging or email. My definition of deep work at the moment, there isn't much of it. There's a lot of deal filtering, which is the job. The job is talking to founders and understanding where they're at and whether or not we can help with multiple hats on. Traktor Ventures is my main hat at the moment, but there is still a little bit of angel investing. You mentioned the syndicates that we're part of. They are becoming slightly more passive for me rather than active. I will still send deals into them, but I'm not managing much of that work. So there's other people managing that stuff now, not for me, but managing on their behalf, and I'm just participating. So I think especially over the last little while with the syndicates, the angel syndicates, is I'm participating more as a passive investor rather than an active investor. The portfolio, as they grow, they need less of me there's more people around who are supporting them. So especially as an investment goes through and gets supported by potentially venture or other later stage investors, I certainly have less impact on them from a business perspective. I'll ping a lot of my founders frequently just to say hi, see how they're going, and that's the relationship I like to maintain. It's easy to send someone a message and say hi. It takes effort to do it when you're not to be the cold start person and go, hey, how you doing? What are you up to? But I do that anyway, so it's pretty easy for me to do that.
Yeah. Obviously, I assume that you get asked quite a bit how to get into angel investing. I think we've had one of those calls as well.
Probably.
I think what has been really interesting sort of following your journey down the investment pathway anyways is, I guess, again, how you sort of constructed that approach where it's not just down one specific model. As I said, you're kind of involved in everything. Can you share a little bit from your perspective in how you sort of think about setting up that portfolio approach to Matt Allen as an investor?
It's always just the people. I'm not specific about a industry or a vertical anymore. There was a time when I was hyper-focused on, about 4 years ago when we spoke on developer tools, just because I came from a developer background, and I felt like there was, I could have a conversation with a technical founder building a technical tool for a technical audience better than a non-technical investor. Which I still believe is true, although the rest of the investing set in Australia is coming up to speed pretty quickly on those things. And as we've had massive dev tools type events like Microsoft buying GitHub and Snowflake IPOing and these large Datadog listing, so the understanding of how big a developer tool can get is no longer like, won't Amazon do that? And like, maybe, but if they don't, this is a potential outcome. So for me, it's do I want these people in my life? There's some arbitrary trust threshold that gets crossed when you spend enough time with someone to go, yep, these people are going to do what they say they're going to do. They're trustworthy and I like them. And they understand the problem enough to keep at it when it gets hard.
Especially with angel investing, and I assume that, for a lot of instances, you're probably the first check-in to companies. You probably don't have the data points there that most other investors or businesses would sort of look for to build up that conviction. Do you have any examples of, I know you said that the line's a little bit arbitrary, but do you have any examples of what that has looked like in founders that has helped shift you along that to build that conviction up?
If I'm really honest, I'm not data driven. I'm seeing more access into some later stage companies now where the data is exciting, and at Traktor, because we are not doing regular investing, we definitely have to look at the data to the point where we're digging through zero P&Ls and forecasts and stuff to make sure that the company is what it says it is and where it's going is accurately forecast. But from the angel investing perspective, there's very little data, and if the data's there, it's not going to be consistent in the future. So it's not data driven. I'm not data driven.
If it's not data driven, like, are there specific things like indicators that you're looking for, such as, I was having lunch with an investors day, and one of the things that they mentioned was I wasn't really sure about this company, but they were able to attract these really high quality people that kind of really indicated that. I'm just wondering, are there particular things that maybe founders who don't have those data points in place can indicate to you or to other angel investors to help build up that conviction?
I think there's if you're a founder who's hopefully solving a specific problem rather than a very generic problem, then it's actually a line that Nikki from Blackbird says is, find your believers. Like, find the people that you don't have to sell them anything because they kind of grok part of and usually it's the problem space. Now, being a generic investor rather than specific investor, so I'm learning a lot about the problem space when I'm talking to founders. But for me, it is that quite personal connection. And I guess over the time of learning about the founder, you're asking them to do stuff and you're gauging their responses to things, and how they respond to maybe some critical feedback, hopefully delivered kindly, but critical feedback around, I'm not quite sure that bit is, maybe not true, but, is that, have you thought about this over there that's parallel to what you're doing, and how they respond. If there's any inkling of, screw you, I'm right, that's really a difficult thing to get by. And I'm not saying I'm right, because I'd never say you're wrong when I would ask a question, and being quite defensive on, there's nuance between being, having their own conviction as to how they got to that answer, especially early, especially on things that are in the future, versus, I'm 100% convinced I'm correct, and you can't even ask me questions about it. That's a bad orange/red flag.
One thing that's come up in quite a few conversations with investors on this podcast has been, looking for founders that are obsessed with a specific problem. And again, referencing back to our first interview 4 years ago, it was really interesting when you were talking about pick and shovel at that time and focusing on dev tools. But a lot of the fundamentals of that, in terms of you wanting to provide an alternative sort of funding source to founders who maybe don't necessarily believe in the traditional venture path, or isn't quite the right thing for them at this current moment in time. It's been, again, like really interesting to kind of hear a lot of the similarities in what you've built with Traktor now. You speaking about 4 years ago, and trying to find that right model. Really curious to know, what is, I guess, it's probably been more than 4 years, but what does that last 4 years look like in going from that sort of dev tools focus, but wanting to do something in providing alternative funding sources to founders, to eventually the model that Traktor is now?
So back then we were starting Pick and Shovel Ventures, which was dev tools specific early stage venture fund. And it was Glenn Gillen, my friend, and I talking to potential investors. And what we realised there is we were not in a personal state to be able to run a very small early stage fund. So we went and worked at Amazon together. I got a job, and then he was my solution architect. So I was doing BD, he was doing SA. And it was actually at my time at Amazon that two things happened. Glenn realised that he was far more of a product person than an investor. Although we angel invest together, but he's not like a full-time professional investor. And I realised that I am. Like, I'm moving further away from product, further away from the code, more into strategy and business and investing. And, I'm happy to be an owner rather than an operator. And our time at Amazon allowed us to meet hundreds, if not thousands, of startups over that couple of years. And I realised that being very niching down on dev tools will be a pretty small niche, especially in Australia and New Zealand. There's not very many of them. And that venture capital is incompatible for most of the founders we speak to. We at Amazon were able to, had the luxury of doing things like looking at billing data and go, oh, you're growing very quickly, maybe we should have a chat. And you go and meet these founders, and if they're not in startup land, they're not at the eating pizzas on Tuesday night at the startup conference, they're just busily growing a company, then they either know of venture capital, have decided against it, but are still capital constrained. They would like to take more capital in the business to grow it faster, but not necessarily at the expectation of venture. Or they're just growing a business that is exciting, but not exciting enough to be venture compatible. So I realised that there's a funding gap. There's this gap where, and there's sort of two types of founders. Some founders that we talk to are, for one reason or another, are anti-venture. We at Traktor are certainly not anti-venture. I'm not anti-venture. I'm the beneficiary of lots of venture capital, both as a investor that's taken some money off the table because venture has bought my shares off me, and as an LP in several venture funds. So I certainly believe in the model, but there's just this dearth of founders building technology companies who, for one reason or another, the local VCs won't back. And I was kind of sad because these people are actually, they're great people, they're solving problems, they've got customers, they've got revenue, they've got all the bits and pieces. They just were, as I said, for one reason or another, either not interested or not compatible. But they still need help. They were still the people I wanted to hang out with. They could do with some capital, but the model, the expectation of, 80% of the VC investments are made, they will write off and it'll go to zero. Like, that was not the kind of businesses that they wanted to be part of, that 80%, which is 80% likely for every venture fund.
Yeah, and it was really interesting speaking to both Noel and Scott, who are two of your portfolio companies with Traktor. One of the things that they both mentioned was, not necessarily anti-venture, just not the right time for them. But I think at least Noel mentioned that she had, seen this kind of model in the US, but there was nothing in Australia. Providing this type of option at least gave them another opportunity to look at accessing capital that was not necessarily available to them otherwise. First of all, do you want to share a little bit about what the Traktor Ventures model is, and the approaches that you sort of take, and I guess how that sort of came together and putting that together for the Australian market?
We believe that secure founders run better businesses. So, security is quite a personal trait, and everybody will have different thresholds as to when they feel secure. So, thinking that a founder, they've got a startup, they've got some revenue, they've got some customers, but introducing capital that is not aligned with their projected growth can create some insecurity. So we believe that securing the capital via aligning our returns with their growth is really important. So the first product that we have at Traktor Ventures is our revenue-based investment product, which is a combination of revenue-based financing where we it looks like a loan, to be completely frank. It's here's a bunch of capital, take some time to deploy it. After 3 months, you can share 5% of your revenue with us until we have achieved a upfront multiple return on that invested capital. So somewhere between 2 to 3. And that'll take however long it takes. So the variable is time. If you go really quickly, it'll come back really quickly, and I think everybody wins in that situation. If it takes time, it's also fine with us. So some companies have lumpy revenue. So if it goes down to 0 1 month, then you don't have a payment and everything's okay. And we're completely comfortable with that. The other component of our revenue-based investment model is some earned equity. So we will negotiate up front. Again, everything's like on a 7-page legal document, of which the first page is variables and the 6 pages are the rest, that everybody's exactly the same. We will negotiate upfront some warrants or options in your company as a fixed percentage of the number of shares outstanding today, and we'll earn those, our entire team, you get access to our entire team for the first 12 months of the deal, and they vest every month. So if you think we're not adding value, you can fire us. So it's at the founder's discretion to go, we're done here, you guys aren't adding value. That hasn't happened. In fact, it's a very similar model to my personal coaching that I've done and my personal mentoring, where there's always an exit clause on the founder's side. So the worst times in my life is when I had some agreement in place, I was earning equity, but I didn't feel like I was adding value, and I tried to fire myself. And most of the time they're like, no, you can't go. Sorry, we've been really busy. Please, can we, get you back in again to do some work? So there's 6 of us on the team. The onboarding is once the capital's deployed, within a couple of days, we're jumping on a 1 to 2 hour call with the founders and anyone on their team they think is at that right high level, our entire team, so we can understand the things they're thinking about, understand the current state of where things are at, and then we as our team will cherry pick the bits that we're good at. So we have people, we have product, we have finance, we have marketing, we have customer service, customer success, and we have me that does all kinds of stuff. So there's enough people on our team who are all very recent operators to be able to work as advisory. And then we set up Slack, so we have 2 shared channels per investment, which is one with the exec team or the founders and the other one with the whole team. So they can to and fro with us as often as they like, and that's our operating model. So that part of the deal goes for the first 12 months, so it vests every month. And that's our first product, revenue-based investment, which we believe aligns our returns with the company's growth. The second product is very much of the secure founders run better businesses. We know that founders who have all their eggs in that one business basket can make decisions that may not be the best long-term decisions because they've got all their risk rolled up in one thing. So we have a secondary option which allows us to buy some of the shares off the founder. So normally when a company raises money, they create new shares and the company goes to the business, and that money goes to grow the business. This is where we buy some of the founder shares off them and the money goes to the founder. So we think that's a really great way for the founder to relay some of their hard work, and it's about securing them personally. So secure the business with capital that's aligned. Secure the founder by allowing them to take a little bit of money off the table, and we think that in Maslow's hierarchy of needs, like shelter is a pretty expensive one. The rest of them are kind of little expenses, but that's, for most of us in Australia here at least, it's expensive. You rent a house or you have a mortgage and it's a big chunk of things, and if you can put a big dent in that, then we believe founders will make better decisions for their businesses. And whether or not it's a conscious decision or a subconscious decision of them not pushing things, or them sort of hesitating on the growth. And this is not to say they have to now rocket growth. It's just, how do we tilt the chart up a little bit and allow them to grow a bit quicker by them going, well, if it doesn't work out, I've at least got this over here. And Keith from Buildkite said it best. It's like I'm playing my game of life and I've hit save. I really love that analogy. And having a save point, not many people get a save point. So that's the second product. The third product is a trust where the founders who go through the Traktor process are able to put some of the small amount of their company into it, and all the other founders do as well. So we're able to create a portfolio for them. So securing them with aligned capital, securing them personally, and then securing some portfolio for them. And most founders don't get to create a portfolio. Us as investors certainly do. Spread it around and get upside from other people doing great work. And I'd love for our founders to be able to have that as well.
So Matt, as I mentioned, I spoke to some of your portfolio founders, and one of the things that they mentioned was, it was great to have this as an alternative funding option. Just really curious to know from a structural point of view, in terms of you trying to convince LPs to put in capital into this particular model, as well as founders that may be not as familiar with you or kind of the Traktor model in general. Have you had any specific questions in terms of, or any hesitancies in trying to get people across the line with this?
Yes. So as far as investors go, no. I think most of the people who invested in Traktor knew they were 0 degrees away from me. They were either, we'd worked together, we'd invested together, or they're one of my portfolio companies, one of the founders, which is great. That was a really nice sign of faith in me, I guess. Quite terrifying for me. I'm the CEO for the first time, so the other startups I was part of were always the CTO and the technical founders. I was building product. So I'm excited about being, the leader and the buck stopping with me. But also it is sort of the DNA of all the things we've spoken about so far. So two of the founders, the two founders we've invested in so far don't have any other, they have some angels on their cap table and some other advisors, but they're definitely in control, so this is what we're doing. A couple of the deals that we're about to do are raising standard capital from angels as well at the same time. And it's been quite fascinating around watching them work through, it's almost like mental allocation. So we've always said, initially when we went to market, it's for bootstrap founders who are doing $50,000 a month in revenue and they want to accelerate, but not necessarily accelerate at venture requirements. So there is a growth ambition there, and they know what they're doing in their business. And the description I've used is like they're at the helm of their company and they're pulling levers and they're watching results happen, but they can only pull it a little bit because they have a hard stop where their bank account runs out of money, there's no more money, and there's nowhere to go. So it's quite often it's confidence capital to be able to pull those levers a bit harder, like give them a bit of a yank. And most of the time it's for things that have a relatively short ROI. So the companies that we're talking to at the moment who are also raising equity capital, it's almost like we are using that money for foundational long-term bets, like building the product, getting the team together to be able to do the things that are going to allow us to be solid in the future. The Traktor money is going into things that have a short ROI, so sales, marketing, BD, where on an aggregated annual basis, these people should be paying for themselves multiple times over. So it's almost like they mentally allocate the shares they've sold for the foundation, and this money, which costs money, immediately costs money or very quickly costs money, but has an ROI. So the things we're doing here are going to pay for themselves, and it's not going to be a problem. And I find that to be quite fascinating because, selling shares, you can only sort of sell shares once. You can't, but you know what I mean? Like there's a finite pool of them expressed as a percentage where all of a sudden you don't want to sell anymore. Another thing is if you're doing something that's working and you know that you can do more of it, and the risk is actually, well, there's not a lot of risk. I just don't, I could pour $1 in the top and more than $1 falls out the bottom, but I don't have any more dollars to do. I'm not convinced that selling shares to do that is the smartest thing to do sometimes. Because those shares, if it works well, those shares are going to be way more valuable in 12 to 18 months' time when the process is well underway. Then go sell some. So it's all about optionality. It's about the founders having the option to run a profitable business, raise a round, hopefully on their terms, on the best terms that they can possibly get, or even sell the business. Our model works. If a founder turns around and says, we got to $2 million ARR or whatever the case may be, and can you help us sell it? I'm like, yep, I'll help you sell it. That's fine. And there's more and more upstream acquisition ability out there nowadays. I spoke to two companies in the States who buy SaaS businesses. They're not going to buy them for 20x like a venture, they're not the multiples venture invests in, but they're not nothing. They're significant for the founders. And that's completely fine. Our business model works in any of these scenarios, and that's why we built Traktor, support the founders to do the things they want to do, and that their definition of success is the first definition of success. And that's an interesting yet nuanced thing to founders must completely understand the preference stack when taking venture money. It's last money in, first money out. And that works really well when there's a massive thing at the end of it. But for the 80% of venture investments that don't get there, it can be quite challenging for the founders where they're at the bottom of that stack. Those ordinary shares are the ones that come out last. And if it's a less than stellar exit, they're going to be the ones that take the hit.
There's so many different directions that I want to take you on. Just, I guess, picking on that thread a little bit, there isn't much discussion, especially in Australia, around secondary shares or secondary options for founders to create some sort of safety net for themselves. When should founders be thinking about that, or what are the types of questions that they should be asking, or when do you think, or where do they go for advice, aside from yourself?
Yeah, I'm happy to talk about it. It's usually secondaries are usually the option gets presented when the leverage is on the founder side. So if you are raising money and there's more people who want to buy shares than shares you want to sell, then there is potentially an option to go, well, I'll sell you some of mine. So you need to get your company into a state where that is true, which is a challenge, especially early days where, if you haven't got any hype or you haven't got any numbers or you haven't got the things that have to create the demand is small and the supply is small and demand, then you're in a world of bother. I don't think it's true nowadays, but certainly before, venture people want to have hungry founders, and the difference between starving, hungry, and fed and well fed is almost the investors. I think it's some of the DNA. So I would rather have a founder at the point where the distractions outside the business are not there. And like, this is pure matter DNA. In my startups, when I was starving at home, it had a drastically negative impact on the business I was trying to build. And that's just how, like, that's just me. Like, that, I just don't want my founders to be in that state. I want them to balance the stuff right so that they can build the business that is solid and dependable, rather than flaky because they're doing things and making decisions that are because they're under stress in their personal lives. One thing I think you'll find most founders might say about me is it gets pretty personal pretty quickly. Like, I will quite often ask them about their personal situation, not because I don't care about it, but it has a material impact as to what the decisions I make inside the business are. And also, if they've got co-founders who have a wildly different personal situation, can create some really awkward decision-making process in the business as well.
Yeah, it's really interesting that you mentioned that, because when I spoke to Scott, that's actually one of the things that he touched on. But more from a perspective of working with you, he said, was more like a friend than a mentor, to a point where, generally with a mentor or an advisor or an investor, you want to be truthful with them, but sometimes for various reasons you might not be completely upfront with everything that's going on. But he said that the dynamic with you was very different, in that it was more like a friend where you can be completely open and talk about all of the bad things that are going on.
So I have this thing where I prefer to take all the data in. I think maybe one of the things that I've gotten relatively good at over the last period of time is extremely quick synthesis of data and extrapolating out what impact that might have, both negative or positive, on the business and the founder themselves. And until your company's at a size where the founders are not critical, which is a long way away, the founders are critical. So sweeping some of that stuff under the rug or not wanting to know about it is really, all you're really doing is sort of setting yourself up for probably a negative surprise down the track. So I'd rather understand it, and I never judge them about it. Everyone's got their own personal situations that impacts their decision making, which as an investor is going to impact my returns. But I genuinely see my returns as exhaust of the founders doing, being comfortable and being comfortable to have a conversation with me and being comfortable to make decisions that are the right ones for the business. And it's hard to have that level of conversation unless you've earned the trust and kept the trust there. So, it makes me sad that investors who, write a check and then don't give a shit, sometimes they're the ones that are the most annoying. They ask stupid questions at times when they shouldn't be saying anything. I've got the context. I don't need to ask silly questions, and maybe that's a positive from the founder's perspective.
Yeah, I mean, again, we've covered the topic of due diligencing founders a couple of times, but there's obviously due diligence, and then there's kind of specifics around this type of situation of like, are they helpful or are they unhelpful in those particular situations? I guess for a founder who's looking to raise capital for the first time, who's coming to you for advice, what would you get them to ask, or what would you get them to look for as part of the due diligence process to identify whether that investor is going to be helpful or not?
Helpful's a word, supportive is another word. I see myself more supportive as helpful. Like, helpful in my mind is like, cool, can you come and do this thing for me or with me? I don't do that very often. I don't have enough bandwidth. So you asked before about how I handle so many portfolio companies, and like, I'm not creating artifacts. I'll write that document for you. I won't do that. I might give you a template of one I've done before, or someone else I've done shared another one, but I don't do that. So supportive is, in my mind, context plus ambition, understanding the context and understanding the state of the business, and then helping them do some sort of risk-adjusted calculations. So if I was a founder asking a potential investor, I like being clear and specific, something that we learnt at Amazon, be clear about it. Will you be able to do this? Am I able to call you on a Sunday? I was on I was on a call last night at 9:30 with a founder that I'm invested in, who's considering taking on a co-founder who we both know very well, and the pros and cons of that at 9:30 at night. There's plenty of people who will write you a check who won't do that, and you may not need that, and that's fine. So I think the challenge as a founder, knowing what your operating method is and what their operating method is and whether they're compatible. It may be that as a founder you send out monthly updates and that's all you want. I would argue that holding context over time is an important part of being, as a founder, of having my investors know that as well. So some of them, and not everyone's the same. You can't have 10 investors. Not everyone's going to be on the phone and responding to messages immediately. But knowing where they sit in the spectrum of, like, can I call you when there's tough things to do versus just send me the monthly update is probably an interesting question. Whether or not you get a straight answer, I don't know. Yeah. Maybe everybody overstates what they can and can't do. I don't know.
What does your rhythm look like with portfolio companies? Is it the same across the board? Do you say, we'll do weekly calls with everyone, or do you sort of work that out individually with founders?
No, I work that out individually. So I would hope that everybody would feel zero resistance to email me, message me, call me when they have a specific question, which happens all the time. A lot of the time it's around recruiting and product, obviously, or fundraising. And I'll respond to them the minute I'm not, doing something that's in a meeting. And that happens all the time. So I think you'll find that being responsive to your portfolio is a great way to be the first person they call, in good or bad. And some founders are far more likely to ask lots of questions, and some founders are far more likely to batch them up and go, hey, can we jump on a call? Some of my most valuable assets, like Buildkite and Practice Ignition, I talk to those founders via message. Like, it's a lot of messaging, casually, most weeks, but not because I'm checking in on my investment. Mostly because I just want to hang out with them and talk to them, and I have questions, or I might see something that's relevant to them and send it across. I don't want to be annoying either, so everyone, again, it's gauging everyone's desire to. As an investor, you need to be acutely aware that some founders, that there is a little bit of a weird power dynamic, and I'm really clear with my founders. I'm like, I don't expect you to. I'm not asking you for an analysis of stuff. I'm just pinging you stuff that's interesting. You can tell me to stop if you like, and it's not like a fire hose.
Yeah, again, one of the things that Noelle mentioned was, oftentimes she knows specifically what she wants to do, and I think most founders deep down have a fairly good idea of what they want, but she said that she had kind of specific examples of speaking to you, but she said, I left that conversation just having the confidence to do that. And I really love what you kind of mentioned earlier in terms of confidence capital. Do you want to share a little bit about kind of experience in helping founders with developing that confidence in being able to execute? You
mentioned earlier, like, everybody's in a unique situation. Everybody's figuring it out as they go. And we spoke about being data driven. I'm gut driven. And it used to drive the people at Amazon up the wall because they're data driven, and I'm like, I don't have the data, but this thing here is a good thing for me to spend my time on, and that's just how I do it. Traktor's interesting because we do have to combine some financial data. There's absolutely hard flaws on things that we need to see, but after that, it's still that our confidence and our conviction to do that. Good founders know what they're doing. The line between confidence and arrogance is that, I want the people who are not calling you after the fact things have blown up, going, I just did all this stuff and took no guidance, and I don't know. So the way I handle it is I just ask questions. I would never tell a founder they're wrong, but I might ask some questions that might, kick them off a different path of thinking, and it doesn't happen very often. And I guess that might be a sign of the people we like to hang out with and the people we make bets on. Is like, you come to them like, that's a really good idea. That makes entire sense, and quite often it's them creating a new process or slightly modifying something. They're like, this has worked, but we want to do this incremental change, or we're hiring we've only ever hired local people, but there's this excellent person in Sydney. Oh, like it feels right, but it's a little bit of a step change. What do you think? And it's like, well, here's the things that other people have considered while they're doing that. Have you thought about? Yeah, we've thought about all that. I'm like, oh, off you go. And it generally works out well. And the interesting thing there, of course, is that if it takes my ability to help them get the confidence to get across the line and it doesn't work out, then, we're all in this boat together. It's like, well, you had a crack at it. All the information we had at the time gave you the conviction and confidence to do it. You then relayed it to me. I asked a few questions. You had good answers. We did it. If it worked out or it didn't, at least we're all on the same page. So I'm also happy to put my skin in the game and say, yep, I think that was a good idea. And even if it worked out poorly, which it rarely does, but I'm glad that's the level of relationship I have with some of my portfolio. Not all of it. Not all of them need that.
So one of the other people that I spoke to in doing research for this interview was Keith from Buildkite, who you guys have had a fascinating journey together. I obviously had Lachlan from Buildkite. Thanks for the intro once again for that podcast. But one of the things that Keith mentioned was, obviously he almost mentioned that Buildkite wouldn't have happened if it wasn't for you, because one of the I think he was running it as a side hustle for a couple of years, for 2 years or so. And I think one of his competitors had raised something like $40 million, and he's like, how do I dial this and turn this into a real business?
Yep.
Do you want to share a little bit about what that sort of journey was like with Buildkite early on, and I guess the role that you played? And also, obviously, Buildkite's probably a really great example of what I guess you're hoping to do with Traktor with a bunch of different businesses. How do you see your role kind of evolving and changing as it did with Buildkite over time?
Yeah, Buildkite was a mate who was part of Keith, who was part of the Ruby community, a software developer, that I got to know over several years, going away for weekends as we did for these things called Rails camps. And I guess I'd become a little bit of a leader in that community. I ran the meetups in Sydney, and then when I moved to Melbourne, I ran them in Melbourne. I was the president of Ruby Australia. So I had this sort of transitioning to a business guy, especially once I sort of stopped being a software developer and started being a recruiter. I was obviously talking to a bunch of non-technical leaders as well about the things they wanted to do. But Keith and I had become friends. He had his side hustle. I think it was he'd solved the problem for Envato where he was working, and then sold it back in there as the first customer. And it may have been doing $3,000 a year or something like that, some arbitrary amount of money, but it was going into his personal bank account. He's like, Matter, I think I'm onto something here. Like, how do you do business? Like, how do you do a business? Like, how does a business work? I'm like, well, there's a bunch of things that we need to do to make it legitimate. We should probably not have it going into your bank account, and so on and so forth. So there was a bunch of guidance and work that we did to set the business up. Tim, the co-founder, joined, and that happened after we had raised a very small amount of money very quickly over the space of sort of 3 days, with 9, I think, early investors, a couple of exited founders who took out a chunk, and then a bunch of customers and friends, really. And I guess it's very nice of Keith to say it wouldn't exist without me. I think it would exist. It exists in a different form. But the interesting part about the conversation we had when we were raising that money was that Keith is not a startup guy. He's like, businesses need to earn more money than they spend, otherwise they're not real, right? And that was the attitude. The attitude was, let's raise a small amount of money, and the sole goal is that the monthly revenue from this business will be able to pay for Tim and I, so that we don't have to raise more money, because why would I want to keep putting more money into something in a business that's not making money? Like, I don't understand. So that was the intent. That was the story that was told to the investors, and that's what the permission was given to do that in particular. And they didn't raise any more money until we had this event at a $200 million valuation, 7 years later, which came from a conversation of me asking the founders, maybe you should try and de-risk this a little bit for yourselves. I know things are going well. I know you pay yourselves well now. I know this thing is profitable because I get dividends from it. Like I understand that it's a going business, but what if you were able to realize some of those gains and become more secure as people, as humans? You know, could we realize some of those gains? Could you buy a house? Would you run a different business? Would your ambition levels change a little bit if you're able to take some of those gains and hit save? So, you know, it wasn't always awesome. There was a few cash flow pinches where, you know, myself and Lachlan had to tip in some money and loan them money, and it came back really quickly. But the trials and tribulations of a small business, a small tech business, are real. But the intent was, we get this thing to stand up as quickly as we possibly can, so that we don't have to keep selling more shares, so that we can run a business that we can make decisions about in the long term. And it got there. You know, I think it was the money we put in plus an R&D tax return, and they were happy to solve the problem for the customer and charge money for it from day one. And I think that being constrained by that, not even constrained by that, but by being focused on that, allows you to have the options as to whether or not you can just run behind the revenue curve. And they hired their first employee. Once they had enough, you know, money in the bank to sort of a couple of months worth of salary for him, all right, we've got enough confidence now to bring that person in, and off they went. And that person also was able to buy a house in this last transaction and still owns a big chunk of the company. So I just like seeing founders think this thing through as to what their definition of success looks like. And the scale of the success, I think, is a variable, but the definition of success is really interesting, because some people want to raise money and they want to grow this enormous thing and have this huge impact, and some people just want to incrementally amp their ambition up over time.
Yeah. You know, I guess from my experience, when I was running Stage Label, I just had the blinkers on, and I didn't have time to sort of look up and think about different sort of options or different kind of approaches. You know, one of the things that Keith mentioned around this was, you know, just and even Noel and Scott mentioned this as well, is just having you open up different opportunities for founders. What are, I guess, from an investment perspective, or having some sort of both vested interest but also being an advisor in these companies as well, what are things that you do to make sure that you're, I guess, aware yourself of, you know, things like secondaries and different options for founders? Is there anything that you do to educate yourself, or anything that you do that kind of helps you understand what the different options might be?
Yeah, I do a lot of reading and have conversations with people from ecosystems. Startup ecosystems are more mature than ours. You got to think that the startup ecosystem in Australia, in its current form, is about 10 years old. Around the world, you know, Silicon Valley was in the 70s. Israel's 40 years old, similar. So conversations and watching the products, you think about these things as financial products a lot of the time. So venture capital has been the one that's been in play in Australia since, you know, Blackbird Fund 1, 2014, I think that was. But as ecosystems that are further down the track than us have these products that are starting to sort of come online here. And then there's even new ones. So the things like, you know, revenue-based investment and revenue-based financing is even newish in the States. So there's some tailwinds, and there's some founders sort of starting to educate and understand that. So for myself, it's definitely talking to the founders of these other companies who run these you know, non-venture capital vehicles, to understand their principles and their values and what they aim to achieve, and their risk profiles. So a lot of this time, you know, the capital is risk aligned. You know, the reason the VCs run portfolio theory and want 100x on their seed to Series A investments is because it's compensating for the ones that go to zero, which is all part of the business model. The Traktor Ventures business model is not that. And, you know, the thing that we don't talk about very often is that if 80% of venture-backed companies don't work out the way that everybody wanted them to. That's 80% of the founders and 80% of the teams who go through a situation that's probably not great. A lot of the time it's quite stressful, mental health. It's like the exhaust of that process is a bunch of people that are not succeeding by the definition of success, probably by most people involved at that stage. So we specifically build our stuff around making sure that we're not putting people into a position where it's a binary outcome, where that we're asking people to go into a state where you strap on the rockets and succeed, or it blows up on the launch pad. And we think that the knock-on effect of there is more teams who don't go through that tough process.
Yeah. Having known you for quite a few years, I think one of the things that is really evident, and obviously speaking to a lot of your portfolio companies as well, is that you're very sort of founder-focused. And one of the things that Keith mentioned, even though he's one of the founders that you worked with closely, was I think he was telling me a story that you brought him a deal for an investment opportunity, and he said, "That's a crazy valuation. I'm not going to pay that." And you're like, and your response was, "Don't screw the founder." Again, do you want to talk a little bit about how, where a lot of that sort of comes from, and how you've, obviously sort of baked that into the different products that you're offering through Traktor Ventures?
Yeah, I think we forget sometimes that there's people who are doing all the work, and us as investors, our work is to find the people who are doing the work and then support them. But usually, let's be clear, the support is, the capital is the main thing, and the other support is interesting. And VCs specifically buy their capital, and anything else is nice to have, but it's certainly not baked into the model. The Traktor model is like those first 12 months, we're going to earn our couple of percent of equity. And if you don't like us, if we're not adding value, fire us. Like, have the conviction that we're being valuable to you. And if you don't think we're adding value, then we're completely happy to let the revenue-based finance mechanism work, and we're not going to be there for you if you don't think we're adding value. And to the point where that story Keith told, exactly that. He's like, what do you mean? Like, that's a ridiculous valuation. And I said to him, when we raised our capital, I was the one that, before we set the price, I doubled it, and everyone went, that's fine. The reason being is I want the founders to own the majority of these companies. They're the ones doing the work. The investors, yes, they're putting capital at risk. Yes, it's a risky business, but they're not doing the work. And the capital is important, but capital does become a commodity in the right environment. You should, and if you've got a good idea and a good product and a good whatever, then you should be able to get capital from wherever you get. So the extra stuff, I think, becomes more important than the capital itself a lot of the time. So that's the DNA of Traktor. It's don't enter into a situation where you're screwing over the founder of their equity. So assuming this thing is going to be a long play, this thing is going to get valuable over the time, I think founders don't quite realize that when they sell 20% of their company to an early stage investor and things go well, that's going to be costly in the long run. So a lot of so Traktor gets its money via its revenue share, and we'll get a 2 times our money over the next 2 or 3 years. It's a lot of money to come out of the business that could have gone into the business to spend on other things. However, if the founder is building a solid ongoing company, then they're going to really be happy that they retain that extra 18% of their company if things go well. If things go consistently and but not rocket, that's also fine with us as well. We're happy to take time to get our returns back.
I'm really curious to know, obviously you've got a couple of different products. You mentioned, one that's, again, for simplification purposes, similar to a loan, and the other one is essentially purchasing a stake in the company. The way that you do due diligence on those particular deals, are they the same? Do they look different? Are you looking for different things?
Yeah, it's kind of a ladder. At the moment, we don't have anyone who's got to the point where we can do the second one yet. So step one part of the diligence we do on the first product is more financial diligence. It's like, let's make sure that we have conviction in the growth up until now, and then look at the forecasts and understand how how this capital is going to drive those forecasts. In our model, we have a confidence percentage on those forecasts, and we dial it down a little bit because everyone's most people are conservative, but we just need to make sure we get it right. By the time that's come into play, by the time the mechanisms are working, us and our accountants are inside zero. We know what's going on. Most of these bootstrap founders are really good in particular. Like, they have their accounts dialed in because they need to know exactly what's going on. It's not like they have an abundance of capital in some bank account where they just don't have to, they just spend stuff. So they're quite particular about it. So, reconciling their accounts and locking down month end and knowing exactly what's what is part of what we do. Once we've got enough of that data and we can see where things are going, that's when we can start the second conversation. So I don't think we'll be issuing the second product unless we've come in via the first product. So you're right. So the way we fund the secondary is we actually go back to our shareholders and say, hey, we know all about this business now. You've been seeing it in our monthly updates. We can see where things are going. It turns out that we have access to, buy a small chunk of it. This is how we're going to do it. Who's in? And we may extend that out beyond our shareholders if they can't do it, but they've all expressed a deep interest in participating in that particular product.
Final couple of questions for me, Ada. One is, we've spoken a little bit about how founders needed the confidence to go out and execute. Keith actually sort of mentioned something similar as well, but he positioned it more as an ego thing, that he needed a little bit more ego, to go and execute, to have the confidence to go and execute on something. I'm really curious about that from an investment perspective, because the time horizons on that is usually so long that it can be a little bit hard to gauge whether what you're doing is on track or not from an investment perspective.
Yep.
How do you sort of think about that personally from an angel investment perspective, where you have a bunch of things that are in play to understand whether you're on the right track and you need to double down in a particular area, or there's particular learnings that you need to take, or potentially pivot in your own strategy?
My lens on that is a statement that I quite often make, and that is ego is expensive. And ego has two sides to it. So it's either expensive because you got to dial it up too far, or it's expensive because you haven't got it dialed up enough. And in Australia, quite often it's expensive because they haven't got it dialed up enough. So in this particular case, Keith his ego was needed to be dialed up a little bit to have the confidence to be able to go out back to his team and say, this is what I think we should do. So where the other way, if you've got it dialed up too much, especially if you're raising money, and Australians are quite sensitive to, ego on the borderline of arrogance. Where in the States, it's interesting. I've said this conversation, especially a lot of the StartMate founders when we used to go over there pre-COVID. It's like the exact same deck in Australia will have investors asking you whether or not are you sure you can hit those numbers? And the exact same deck in the States will be like, those numbers really aren't exciting. Like, I think you need to jack it up a bit. So we live in this weird space where you got to dial it up but not too much here, and then you got to over dial it when you're there. And then to your question about the portfolio is confidence is quite often when the ego just needs to be dialed up a little bit more. It's like, have faith that the way you're feeling, that the data that you have internally, we need to ratchet things up a little bit. But that's also tough when you've got a team around you who have certain, things are working a certain way, and quite often it's the difference between incremental changes and step changes. I think we need to break the way we do something, but everyone's comfortable with that and things are going okay, but I want them to go better. That's a thing where the questions that I ask in my coaching capacity, and there's some founders I speak to every week just to help them get this dialed in, to almost thread the needle sometimes of, because you don't want to over dial it and, come in sledgehammer, and you don't want to let it go too long because you don't have the confidence to do it. It's about getting to the point where they're confident enough to be able to say, righto team, this is what we're doing. And it's hard. I don't think you can ask your team to innovate on a bunch of those big chunky things sometimes. Like, you can, but especially if you've got a new team that's forming, they're going to sort of keep things going in the same direction. So the leaders or the founders are the ones who have to go, oh, I've got the conviction, I've got the confidence, I've listened to, my founders and my advisors to go, yep, that's what we're doing, but it's different. We're doing a reorg, we're restructuring, we're doing whatever we have to do. You can't ask your team to do that.
Yeah. And obviously, a lot of what you're sort of focusing on and the type of founders that you're probably looking to back on Traktor are companies that have been bootstrapped for the majority of the time period. Again, speaking to a lot of bootstrap founders, there's, and I've had DHH on the show, who's got very particular views on bootstrapping versus venture. And obviously, sort of Lachlan spoke about the Buildkite story as well, in terms of following a similar journey. There's the one camp which is, traditionally you need venture to grow your business, and there's the other camp where, you can almost fall in love with the idea of bootstrapping and not think about additional kind of sources and think that that's the only way. Do you have any advice for founders who are kind of in that type of mentality in terms of, I guess opening up what might be the opportunities with looking at things like not necessarily venture capital, but venture debt or other forms, and trying to decide what is the right path for them?
Yeah, a lot of the time, I think it comes down to their internal definition of success and your own limiting beliefs. A lot of the time, I'm bootstrapping because I don't want to take that external pressure. A lot of the time, it's pressure, and if they're comfortable with building something small, that's fine. Like I think in startup land, people who want to do something just for themselves get judged poorly. I don't judge them poorly. Like they're also not something who I'm going to be able to help at Traktor either. Like there's this, we almost feel like we sit in the middle. You can build there's so many people around the world who have basically create themselves a really nice salary with no expectations and no one else involved. And if you want to do that, that's fine. The other end of the spectrum is, before you have any kind of inkling of how awesome it's going to be, you've sold 20% of the company and you've definitely strapped the rockets on. We feel like we can slide up and down that scale. Now, obviously, Traktor is an investment company. We do need to get returns, but our model is pretty straightforward. It's like we know exactly the multiple we're going to get. We know exactly how we're going to get it, and the bet we're making is that with this capital plus our help, that acceleration will accelerate to the point where you're excited about it, and it's pulling you forward, and we're there to help you, and we'll get our returns, and we'll be potentially just be gone and be a small shareholder and get out of your way. So I don't think anyone should fall in love with either of any of the spectrums. I mean, besides, I want to build a lifestyle business, I don't want anyone else involved, go nuts. If that's what you want to do. I think Buildkite's a really good example of ambition amping up over time. So the initial desire to, pay for their own salaries, and now, if they're not the best CI platform in the world, they're doing it wrong. That's where the ambition has gotten to. And it happens most of the time.
What's the sweet spot for Traktor?
At the moment, if you have $50,000 a month in revenue, like that's a pretty easy conversation for us to start. I think over time that will come down a little bit, and if you're not there yet, but certainly heading there at a rapid clip, that's a conversation we'd love to have. Most of our investment companies are between $100,000 and $200,000 a month, so they're well-established companies with millions of dollars in revenue. And some of them, we actually have a conversation in play with someone who's doing $1 million a month in revenue. They want to buy a company that will pay for itself, but they don't want to spend any money off their cap off their balance sheet right now. So there's a different use cases. The majority of the use cases is we know what we're doing. We just want to do more of it, and it's going to drive the top line without incurring a bunch of bottom line, expenses. So we're not really geared up for people that want to hire 10 devs that are going to build a product that will hit the light of day in 24 months' time. That's not what we do. But yeah, that sort of revenue around the $50,000 a month is where the conversations become pretty straightforward.
Fantastic. Matt, once again, thank you for coming on the show. Highly recommend anyone who is thinking about alternative funding options to go and talk to Matt as well. What's the best way for someone to pitch you or get through your filters and have a chat?
Yeah, so traktorventures.com has a booking form to have a chat with us, which is great. There's just some office hours up there that are standing office hours, so happy to have those conversations. You'll talk to Jody first, and then we'll bring it inside the team. I'm on Twitter all the time, as you know, so I'm happy to take a DM there. I'll probably just send you a Calendly link and we can have a chat. So that's it. Anywhere else, LinkedIn's a bit of a dev null, so don't ping me there.
Yeah, awesome. I'll make sure all of those links are on the show notes. Adam, once again, thank you for coming back on the show.
Pleasure. Thanks for having me.
Cheers. Thanks for listening to episode 137 of the Startup Playbook Podcast. As always, full show notes from this interview will be available at startupplaybook.co. I'll be back next week with another interview, but in the meantime, if you enjoyed this episode, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.